Right, hello everybody. I'm Joe Neighbour, one of the directors at Signal Centre. In these unprecedented times, we're going to be running a series of webinars for people just to sharpen up some trading and technical analysis skills. It's all absolutely free, so please do enjoy it. Now, what I'm going to go through today is talking about setting up your charts. Now, this isn't the most glamorous of subjects, but it's something that could give you an edge over the course of time when you're when it comes to trading. So if you have any questions about any of this, of course, you can get in touch. You can message us on Telegram, or you can get in touch directly with me on Skype or email, totally up to you. But just going to run through a couple of bits for you now on this presentation. Now, what I'm going to be going through today is talking about chart scales specifically. And as I say, it's not the most glamorous of topics, but something that you need to be aware of. I'm going to talk about log scale charts versus linear scale charts and which is best, and also going to touch briefly on stock charts and why you should be looking to adjust those accordingly as well. So moving on, all chart scales have, or all charts have two axes. We when it comes to price charts, that is, we have the x-axis to plot time and a y-axis to plot price. Now, there are basically two ways of plotting price. That's the linear scale and with a logarithmic scale or a log scale. Most traders are unaware of how price scale is set. It's worthwhile checking with your chart providers and your trading platforms which scales it's set to, because there are some key points that you need to consider. Now, the interpretation of charts can vary quite dramatically when you're looking at these two different types of price scales. With a logarithmic scale, that spaces price on the vertical axis dependent on the percentage change of an underlying asset. This is usually the default setup. It's not always the case. I think TradingView don't necessarily default to log scale, but I will come on to show you some examples of this. On a linear scale chart, prices are spaced using equidistant spacing, and it's designed to show you absolute values. Now, what does this all mean? Well, if we take a look here at the Bitcoin chart, this is the Bitcoin weekly chart, and what we have here is a linear example. So this shows us the entire price history of Bitcoin. If you take a look at that grey box in the on the left hand side, you can see that the price is not very easy to read on that linear scale. If we take a look at the y-axis, you can see that the units of price change in lots of 1,000. Often trading linear with linear scales, you can look for day trading opportunities because obviously percentage moves aren't so exaggerated. But this is a linear scale example. Now, as a technical analyst, looking at that example of Bitcoin, there's not really a lot you can do with that early price action between 2015 and 2017 as a technical analyst. And also, you can't really get an overall picture of the overall trend using that weekly chart with Bitcoin on a linear scale. If we now look at the log scale or the logarithmic scale, what we can see now is that the price on the right hand axis is split up in percentage changes, and obviously we can see that starts down at sort of $100 and has moved steadily up to its highs that we saw at $20,000. And the price is obviously separated by percentage amounts. That can be anything on any chart. They're all different. It can be 5, 10, 15% or even more. Now, logarithmic scales are very useful for longer term perspective. That same box that we showed on the previous slide, that grey box, is exactly the same price action as we see here on this log scale chart. Now, as a technical analyst, obviously now the price action is much easier to read and the trends are far easier to define. So clearly in this instance, using a log scale chart is far more preferential for a technical analyst, particularly over longer term charts. Now, what I'm going to talk about now is not often talked about. I know not many of the people that we converse with on a daily basis trade stocks, but most platforms, stock data is not typically adjusted for regular dividends, and I'll show you why that's an issue. Trade data is only typically adjusted for stock splits and also special dividends that are paid out. Now, dividend adjusted charts, what they show you is the total return of a share price. So it rolls in all the dividends into the price and gives you a real, a total return of what you could have achieved on a particular stock. If you don't adjust your charts for dividends, then you're not getting all the data, and you could be understating your returns as a result. And it could also result in a lot of missed opportunities, as I'll now show you. This is a chart of National Grid. Now, National Grid is a big utility stock listed on the FTSE 100. This is a non-adjusted chart of National Grid, and the chart shows the price is trading below some previous highs here. So if you had just taken this as a standalone opportunity to try and trade, if you were looking to buy National Grid, there is no chance that you're probably going to buy it where it's trading at this particular point in time, because it's trading below some massive resistance levels, as you can see here at this 1097 level and at this 1148 level. Now, this is a non-adjusted, as I say, non-adjusted chart, so no dividends have been factored into the price here. Now, if we take a look at, skip a slide there, the adjusted example, which I seem to have dropped off. Okay, let me show you the adjusted example. I'll stop sharing there and share this screen. So this is the non-adjusted example that we have here. So again, we've got these levels of resistance on the chart, which actually work quite nicely. This was the original presentation was put together obviously prior to a big crash in stock prices. But what I'm trying to highlight here is this is a non-adjusted chart. Now, if we take a look at the adjusted chart, now the dividends have been factored in. We're looking at the same levels or previous resistance levels. And if we look at this one here, we can see a nice clean breakout above the highs. So we've had a breakout here on an adjusted basis. So on a total return basis, we then saw a really nice pullback to retest that new support, followed by a fresh push to the upside. Now, as primarily an equity analyst, if I had not spotted that, then I could have potentially missed out on 14.5% worth of upside when trading National Grid. So it's important to adjust your charts on a dividend basis. Now, how do you do that? This is a trading view chart. Now, all the scales for trading or for your charts are down here in this corner. So where you see the ADJ, that will adjust data for dividends. So you can click on and off of that, and you can see how the price changes as a result of that. So this is without. This is the resistance levels that we were looking at on a non-adjusted basis. When we adjust the charts, we can see that the prices are up here, but those resistances are down there. So that's an adjusted and a non-adjusted basis. Now, when we were talking about log scale charts and linear charts, let's just type in that Bitcoin again into there. Again, looking at the weekly chart. So what we have here is a linear scale chart. So we can see here we've got all this clustered price action around here. And what we have on the left-hand side is the log scale chart. Again, they're down here. So if you click on here, we've got the linear scale chart. If we click log, then it will update it for us, and the differences between the price will be listed in a percentage change basis rather than on a linear basis as it was previously, and which I've changed here. So rather than changing price in amounts of 1,000, we're now changing it in percentage terms. So that's a difference between linear and log scale charts. Say not the most glamorous of subjects, but it's a little tip that you should all look to use. Log scale charts definitely is the way to go if you're looking at longer term charts. If you're looking at charts on an intraday basis, let's just take a look at this on an hourly chart. Then it really isn't going to make a whole lot of difference because we're not talking about huge percentage moves. But let's just take that off. So that's the linear version of Bitcoin. And if we change that to log, there isn't really a lot of difference there that's going to impact your trading in any big way. So log scales for longer term charts and dividend adjusted charts when you're looking at stocks would be the key takeaways from that today. Again, if you do have any questions, feel free to get in touch. We're going to be doing a few more of these over the course of the next few weeks. And next time I promise to have some more interesting stuff for you. So that rounds that up. That's going through charter setups with myself, Joe Neighbour, and we will be in touch with you all again very soon. Take care.